Right, so thank you for coming online for the last class on financial management. Right, we have covered with today's session, we will be covering the entire areas that need to be covered under financial management. But having said that, now the onus is on you, right? It's up to you all to do your studies, go through whatever we have done. And I would also advise and recommend all of you to come for the revision classes, which I think kicks off sometime next month, so that you'll be better prepared for the exams. You will know what to expect, and we will also be discussing exam techniques, right? So exam techniques are also critical. It might be the difference between a pass and a fail. So this is the best time where you get an opportunity to fine tune your writing skills, in the sense, well, your English might be very good, but it's a matter of how you articulate your answer so that you meet the examiner's expectations, right? So you have to incorporate everything that the examiner said and everything that you have studied over the last 6 months into a 3-hour paper, which is not the easiest thing to do. Right? It's an art. Right? So come for revision classes and we will discuss. We will discuss questions in it. Okay, so let's go on with today's session. It's on liquidity management. Right? Now, one moment. Now, liquidity is critical for any bank. During the 2008 subprime mortgage crisis, we saw how important it is, because Lehman Brothers, right, collapsed because they did not have liquidity to settle their obligations. They had written so many collateralized debt obligations, credit default swaps, which got triggered. So the swap payment came in, they got the demand to pay, but they had no liquidity to settle it, right? So liquidity is crucial for any organization. Now, if I may ask you which is important, whether it's the profit or the liquidity, what would you think? What do you guys think? Which is important? More important? Is it the profitability or the liquidity?
Liquidity.
Yes. Why? Because you're right.
You can't sustain without liquidity.
Exactly. Without profits, you might be able to survive because you have shareholders' funds, equity, retained earnings, and all that. So for a short period of time, at least, you might be able to survive. There might be some cushion for you to absorb the losses. But if you don't have liquidity, you might be showing thundering profits. But if you don't have the liquidity, then you may have to default on your obligations. If you default on your obligations, you can get sued and filed for bankruptcy. Now look at Enron. What happened to Enron? This was sometime in 2000, early 2000. They became the #1 company in Fortune 500. The same year they went bankrupt, right? Because they showed lots of profits, no liquidity. And what had they done? They had cooked their books. Some of the expenses which had to be written off had been capitalized, but they did not have the cash flow. Right? So Kenneth Lay, their CEO, was in the news. That was a hot topic at that time. And what was worse was the auditor, Arthur Andersen, right, a very reputed company, had allowed the practice. So there had been some collusion amongst the two companies, and that's what led to the Enron collapse. So along with Enron, Arthur Andersen also had to close down. That's also because of liquidity. They ran out of liquidity. Look at Barings Bank. Why did Barings Bank wind up? Because who is the trader at Barings Bank? Just a little bit of revision while we are on it. The trader at Barings Bank?
Nick Gleason.
Nick Gleason. Right, Nick Gleason got into so much of losses and the bank kept funding the losses without realizing that it was their own account that they were funding. And eventually the straddles, remember, got triggered, right? So Bannings Bank didn't have the liquidity to settle. So they also had to wind up. So which means liquidity is critical for any organization. A bank is considered to be liquid if it has ready access to immediately spendable funds. Very important point. You should have immediate access to spendable funds, right? If you want cash flows coming in today, there is no point getting it next week, right? So if the requirement is today, you have to have the cash flows ready today itself. Any delay is going to be trouble. That is the main thing when it comes to repayment of our sovereign bonds and all. Right? We have cash flows and obligations coming up in January, which we have to settle. Right? So it's very important that we get the timing right. Then the cost has to be right. Now, if you take the sovereign bonds, our cost is around 20%. So if you raise another sovereign, if you do another sovereign bond issue, it will have to be 20% above, which doesn't make sense in dollar terms. So the cost will have to be reasonable, at a reasonably affordable cost, right? At precisely the time those funds are needed. Okay, so the timing has to be right. A liquid bank has the right amount of immediately spendable funds in hand and can quickly raise funds by borrowing or by selling assets. So there are a couple of ways to generate funds or to source funds. You can maybe borrow. If you have borrowing lines, you can borrow, right? Maybe from money markets, or if you want long-term funding, perhaps from capital markets, you can raise equity, do a rights issue and all that. Or if you want short-term, you can go to the money market, do call money or repos, or by selling assets. Maybe you can sell your treasury bills or bonds, some of the liquid assets. Then if you want further cash, you might consider selling some of the assets which are not in use or underutilized. Maybe it might even get to a point where you sell some of the physical assets like land and building, right? So there are so many ways of sourcing funds. Now, when you source funds, how do you do it? Do you go for the cheapest source first or the most expensive one first? What will you do? The logical way of doing it is, yeah, hello?
Cheapest one first,
Yeah,
then if we
cheapest one
couldn't find
first.
it, then
Yes.
expensive.
Huh?
If we couldn't find only, then we go for the expensive one.
Exactly. Yeah. So you have to go for the cheapest source first. Now, for a bank, perhaps the cheapest source of funds are current accounts, right? Because in Sri Lanka, we don't pay any interest on current accounts. So we try to can mobilize more and more current and savings deposits for the bank, right? But it's not an easy task, right? Because the investor or the customer is also aware that he's not getting any interest, right? So he will not give money for free, no money for jam. So it's very tough to canvas and mobilize current and savings accounts. So if you want funds in a hurry, you might have to go to slightly expensive sources, right? So you have to strike the right balance between cost and efficiency, right? And timing. Lack of liquidity is the first sign that a bank has financial troubles, right? So if it doesn't have enough liquidity, there might be indicators that banks are having problems. Things like now recently there were some of the finance companies which collapsed. If you all had followed the cases, right? Well, these were in the media, so everyone knows now. The finance, for example, right? First indicator was customers were not allowed to withdraw money. Then they wound down their business. The lendings started stopping. deposit rates going up, they started making losses, right? Things like that can be indicators that bank is having financial problems. The bank will start losing deposits, right? So that's because people will get to know the customers. It's a small community, Sri Lanka. Everybody knows each other in some way, one way or the other, right? We are all connected. Well, actually, if you want to contact any person in the world, right? I'm just trying to explain how closely the world is connected. If you want to connect to someone you never thought of, you will be able to contact, right? Let's say you want to contact a celebrity, Arnold Schwarzenegger, or you want to contact Barack Obama, right? Or anyone you want. They are probably maximum 5 calls away, right? Only thing you have to call maximum perhaps 5 people, because one person is linked to another one, right? So through those contacts, within 5 calls of 5 people, 5 contact persons, contact points, you can contact any person in the world, right? Except of course the tribes in Amazon and all that. But everybody is connected. It goes to show that the entire world is connected, and only 5 persons away from us, maximum. So if you want to contact maybe Aishwarya Rai or even Mia Khalifa, right? Just 5 calls away, right? Only thing you have to find the right contacts. Yeah, so the indicators that bank are in financial troubles are the bank will start losing deposits. Then they may have to dispose of the liquid assets. They might start, like one of you already said, they will start selling their bonds first, and then the more illiquid assets like land and buildings, motor vehicles and all that will have to be disposed. They will start borrowing at high interest rate, or will have to place collateral. No one will be willing to lend without security. Other banks will stop lending. Lending lines will be cut. Supply and demand of liquid funds. Where do banks get funds? The sources or the supply of funds come from deposits. Then revenue from sale of non-deposit services, right? The commissions and all that. Loan repayments, when customers settle their loans, you get inflows coming in. Sale of assets, right? The bank might sometimes auction some of the assets, perhaps they might go for parate executions and all that. So that will also generate money, bring money into the bank. They may borrow from money markets, right? And demand for liquid funds or demand for funds, the fund outflows can come from withdrawals. Customers may withdraw their deposits. There may be loans being granted. Right? So whenever a bank disperses a loan, there'll be an outflow. Repayment of non-deposit borrowings, right? If a debenture matures or you have to pay coupon interest, there'll be outflows. Operating expenses, right? Your overheads, utility bills, taxes, and all that have to be paid. Now there's going to be a tax surcharge. Almost all the banks are going to get hammered on the tax surcharge, 25%. And so that also is an outflow. Dividend payments, right? Almost all banks declare dividends annually. So that will also have to come through the existing cash, which will go out, right? So considering all of these, we can arrive at what is called the net liquidity position of a bank, right? Which is the net of the supply of money, of liquidity, and the demand. So you net them off, you get what is called the net liquidity position, right? Supply of liquidity and demand for liquidity. The net gives you net liquidity position. If it's positive, there is more supply than demand, and if it's negative, there is more demand than supply. So if it's positive, you have a liquidity surplus. Okay, so it's always good to know whether you have a surplus or a deficit. When you know whether you have surplus or a deficit, you can better manage the situation. So if you have a surplus, then you have to decide where to deploy the funds. But if you have a deficit, you have to decide how to bridge the deficit. Okay, so negative is liquidity deficit, when and where to raise additional capital. If it's a surplus, the management need to decide when and where to invest the surplus profitably until they are needed to cover future liquidity demands. Now, what do you think is best, to have a surplus or a deficit? Yeah. What is best? What do you think is the ideal situation, to have a liquidity surplus or a deficit?
Balance between surplus and a deficit.
Yeah, quite right. Well, what you actually mean is, it depends, right? Because if, remember what we discussed last evening on ALM, if interest rates are moving up, right, you probably should have liquidity surplus for a given period, because then you can deploy your funds at higher rates. But if interest rates are going down, it's good to have a negative liquidity position, because you can perhaps borrow at lower rates. Okay, so it depends. Yeah, so let's try this example. Bank A faces the following cash inflows and outflows. Right, so let's calculate the net liquidity position of this bank. Shall we try it?
Can you show us the question again?
Yes. Okay, you need to calculate net liquidity position, which is supply minus demand. And this one. First one. So withdrawal of a deposit. So that's demand or supply?
Demand.
Yeah, it is demand. Can you all see the Excel sheet?
Yes, sir.
Okay, okay. $8,300 will be on the demand side. Then there's a loan repayment of 108 million. So a customer, let's say, is settling a loan. Is demand or supply?
Supply.
It is supply. And operating expenses. Demand or supply?
Demand.
It's demand. Loan request?
Demand.
It's demand. Sale of assets?
Supply.
Yeah. New deposit?
Supply.
Yes. Money market borrowing?
Supply.
Non-deposit service fee?
Supply.
Yeah. Repayment of borrowing?
Supply.
No, it's demand. No? You have to settle your loans, obligations. Hmm? Isn't it? You all agree? Is it not demand? And dividend payments?
And demand.
Again, demand. So you have a net liquidity surplus, right? Demand is 786,800. Supply, supply is 786,800. $318,700 is the demand. So net is the net of these two, which come to 468,100. Correct? So it's surplus or deficit?
Surplus.
surplus. That means you will be left with a positive cash flow. Now, when you have a surplus, the next thing to do is you need to identify where to invest the surplus, right? What would be the best sources of investment? How would you deploy the funds, right? So that is the role of maybe ALCO. ALCO will have a look at interest rates, market conditions, and decide whether this has to be invested short term or long term. Okay. Liquidity has a critical time dimension. It's time bounded. You can have maybe immediate needs or long-term needs. Right? Immediate needs might come from a sudden withdrawal of your deposit. And if a customer, let's say a high net worth individual wants to all of a sudden uplift his deposits, right? He has to make some investment. So that has happened. That happens quite often. Then, if you have borrowing from another bank, can be used. Right? If you have borrowing lines, you can use it. Or you can have long-term needs, right, which can come from seasonal, cyclical, or trend factors. Right? So seasonal means, you know what seasonal, cyclical, and trend factors are? Seasons means, now in Sri Lanka we have the rainy season and the dry season, right? So during the rainy season, you might see that if you're say for example, you're a umbrella manufacturer, right? Demand for umbrellas might increase during the rainy season, or raincoats might increase during the rainy season, right? Cyclical could be things like economic cycles, right? The economy goes through depressions, and then there is a boom all of a sudden in economies, and so you can have cyclical factors. Then trend is the latest trends in the market. Now, perhaps these days, more and more people are getting into cryptocurrencies and all that, right? So there can be investments moving into cryptocurrencies, right? So those are trends. Okay, so other thing might be with interest rate going up, that is also a trend. There are certain trends, right? Sometimes you might notice that during New Year, you might have withdrawals of deposits because people prefer to have more cash with them. So if you can identify the seasonal, cyclical, and trend factors, maybe you can better plan for them, right? If you see an outflow of funds in April, maybe you can advertise in advance and say that you have out of the bonuses, out of the Vasi, something like that, and try to mobilize deposits, right? Or you can accumulate liquid assets so that you can do repos and borrow. Or you can go for long-term borrowings. Maybe issue a debenture. Most liquidity problems arise from outside the bank as a result of the financial activities of customers, right? Because what your customers do is beyond your control. Now, maybe your customers might decide to invest in equity, stock market. Then they will pull out funds from their current and savings accounts and put them in shares. And so there might be an outflow from the bank. Liquidity problem is a continuous issue. Rarely the demand and supply of liquidity matches at a given time, right? You can never have a perfect match between the demand and supply of liquidity. You will always have to run a mismatch. Now, running a mismatch is good or bad? What do you think? Yeah. Mismatches are good or bad?
But
Okay. Why?
because we have to settle back the customers when they demand their money.
Yeah, but actually, banks are in the business of managing mismatches, right? It is in the blood of bankers to manage mismatches. You always battle with mismatches because you always have short-term depositors, long-term borrowers. That is a mismatch. It's inevitable that bankers have to manage this mismatch, which is actually good. It's actually good, right? Because through the mismatch only you make profits. Because of mismatches, you get opportunities, and these opportunities are what you should capitalize on. Then there is a negative relationship between banks, liquidity, and profitability, meaning higher the liquidity, lower the profitability. What do you all think? You all agree or disagree with that? Is there a negative relationship between liquidity and profitability? Or is the relationship positive?
Negative relationship. If they do have more liquidity, then they can't earn more money out of it.
Yeah. Why?
The funds are stagnated because they are not utilizing the funds to generate additional income out of it.
Exactly. Very good. Right now, the best or the highest liquid source is cash. Right. So if you have all of your liquidity stacked up in cash, what is the return it generates? What return would cash generate? Yeah. What do you think? If you have all of your liquidity in cash, what sort of a return would it generate?
Zero.
Zero. Right? Zero return, meaning higher the liquidity, lower the profit. Then if you have the next most liquid is treasury bills, treasury bonds, again low return, right? So having funds in treasury bills, bonds, or cash will negatively affect your profitability, right? So you have to strike a balance between your liquidity and profitability. Now, on the other hand, if you have invested in things like real estate and all that, it has minimal liquidity, no liquidity at all sometimes, right? Hardly any liquidity, but the returns can be pretty high, right? So there is an inverse relationship between liquidity and profitability. Then interest rate risk and liquidity. If interest rates rise, financial assets that the bank plans to sell to raise funds will decline in value. Do you all agree with this statement or disagree? If interest rates go up, what will happen to the value of financial assets? Yeah, what do you think? Remember the bond and interest rate relationship, bond price and interest rate. When interest rates go up, what happens to the price of bonds?
Goes down.
Goes down. Yeah, that's a negative relationship. So if interest rates if interest rates rise, the value of most financial assets will fall, right? If you all remember, equity valuation, Gordon's dividend discount, uh, dividend growth model, right? When interest rates go up, value of shares will come down because you are looking at higher discount rates and all that, right? So when interest rates go up, the value of financial assets will come down. It will make losses and raise little liquidity by selling, right? If you sell at that point when prices go down, you might end up making losses. Also, the borrowing cost will increase, right? Borrowing cost will go up. Reasons for liquidity problems, what causes liquidity problems could be mainly maturity mismatches, right? You have, as we discussed at the beginning, you have short-term deposits. Most of the depositors go for maximum 1 year, not beyond that, whereas your assets are long-term. You borrow large amounts of short-term deposits and reserves and give long-term loans. And bank sensitivity changes in interest rates. When interest rates rise, depositors withdraw money, searching for higher returns, isn't it? You would have come across so many customers who always bargain for maybe 0.25% or even 0.1% higher. And if you don't give it, they go to another bank. Then the value of assets will decline when interest rates go up. It will increase the cost of borrowing in money markets. Money market borrowing rates also will go up. Banks must give high priority to meet demand for liquidity, right? So if by any chance, if a customer comes to your branch and asks to withdraw 10 million rupees in his account, right? If the bank or the branch at that time does not have 10 million in the vault, will it be a positive thing or a negative thing for that bank? Yeah. What do you think?
Negative thing.
It will be negative, very negative for the bank. Right? That goes with reputation risk. So strategies of managing liquidity. You can use asset liquidity management, borrowed liquidity management, or balanced. Right? Asset liquidity management is called asset conversion strategy. Borrowed liquidity management is liability management strategy, and balanced using assets and liability both. Right? So you can either use the asset side, you can use the liability side, or you can use a mix of either. Asset liquidity management or asset conversion strategy, right? Older strategy, very simple strategy. Basically, what it means is all your liquidity needs can be stored in liquid assets, right? If you, whatever the liquidity needs you have, you store it in liquid assets. So you can have maybe in cash or government securities, in liquid assets, either way. Right? So that's why it's called assets. All your liquidity needs are stored in the form of liquid assets. Liquid funds are raised by converting non-cash into cash. Right? So non-cash items can be converted into cash items and stored in liquid form. Liquid assets have a ready market. their prices are stable, and they must be reversible, right? So examples of liquid assets. The number one liquid asset is definitely cash. Other than cash, you have treasury bills, central bank reserves, your repos, which you can use, your placements with other banks, some of the bonds you may have, commercial papers, right? So this is the most important slide of this series. Asset liquidity management is ideal for smaller banks. And smaller banks which have very little or limited borrowing lines should engage in asset liquidity management, right? Because they don't have lines from other banks and they cannot depend on them. It's mostly used by smaller banks and it's a less risky approach, right? It's not very risky. You carry minimum risk. Now, if your strategy is carrying low risk, the returns also inevitably will be low. The cost, the bank will lose future earning potential, right? Because you're losing your liquidity, which you may have invested, right? You will lose that. There can be transaction costs. Now, when you sell treasury bills or treasury bonds, there can be brokerage which you have to pay, taxes and all that. Then you might have to incur capital losses, right? So if you are selling in a hurry, then you might have capital losses. It will weaken the balance sheet. Okay, because you're selling your highest quality assets. The high quality assets are being sold, and what you're left with, which gives you high returns, are the lower quality assets. That's why the returns are also high. Liquid assets have the lowest return. So that's a positive. You are getting rid of the low return assets. Management should sell least profit potential assets first to reduce opportunity costs, right? So when you sell your assets, you should have to sell the assets which give you the least profit potential. Then borrowed or liability liquidity management. Okay, so there are three strategies. Remember: asset liquidity management, liability liquidity management, asset and liability liquidity management, or balance liquidity management. So borrowed liquidity management is about purchase liquidity, meaning you depend on your borrowing lines, borrowing enough immediately spendable funds to cover all anticipated demand for liquidity. Advantages: you borrow only when it actually needs funds. There is no need to hold less profitable liquid assets, right? Because if you borrow in advance, then you might end up in a surplus liquidity position. So your borrowing cost might be more than your investment return. So if that is the case, it makes no sense of borrowing in advance. As if you have the advantage of scale, if you have scalability, if you are a big player in the market, you don't have to borrow in advance and keep. You can use your borrowing lines. So if you don't have liquid assets in liquid form, if you're depending on your borrowing lines, it will not change the composition and volume of asset in your portfolio. Right? Because you can have a portfolio mix that suits you. Sources of borrowing can be from central bank, like SLF. So you can pledge some of the bonds that you have and borrow through SLF. And selling of liquid assets under repos. Right? You can borrow interbank through repos. You can issue a certificate of CDs or euro currency deposits if you are overseas. Interbank borrowings, you can mobilize deposits. Now, these are not the only sources, and there are so many other sources like mobilizing deposits, do a rights issue, things like that. And borrowed liquidity management can be used by large banks. It's mostly used by large banks because these guys have borrowing lines which can be used, right? So it is usually used by large banks. The smaller banks will go for asset liquidity management most of the time. But borrowed liquidity management is a risky strategy. Risky, right? If someone pulls the plug on you and cuts your lines, then you might get stuck. But it has the highest return because the amount of funds that are idling will be minimized. Disadvantages, your borrowing cost can be very high, right? So you are exposed and you depend on other participants giving lines to you. If by any chance a line is cut or they increase their lending rates, then you are in trouble, right? If that happens, it might have an negative impact on your profitability. Then sometimes may not be available. If the market is short of liquidity, you might not have enough funds. It may lead to bank runs, right? Now, if a bank continuously borrows and all of a sudden it is unable to borrow its requirement, it cannot meet it, then the confidence will dip and there can be a run on the deposits of a bank. Then balanced liquidity management is where some of the expected demand for liquidity are stored in assets, while other anticipated liquidity demands are met by arrangement for lines of credit from correspondent banks or the suppliers of funds. So you strike a balance between asset liquidity management and liability liquidity management. Right? You have part of your requirement in liquid form, maybe treasury bills, bonds, and cash, and the balance you depend on your borrowing lines, right? So you don't entirely depend on either the assets or nor the liabilities. Okay, so the benefit is you can again have a balance between your profitability, also your borrowing lines. Then unexpected needs are met by near-term borrowings. If there's something unexpected coming up, you can use your borrowing lines. Longer-term needs can be planned for and funds to meet them parked in short-term and medium-term loans and securities. Right? You can plan for your long-term needs and store them accordingly. Guidelines for liquidity management. It must keep track of all activities of all fundraising and fund using departments within the bank and coordinate with the activities, right? So if you are managing liquidity of a bank, very important to know when a big deposit is either coming or especially when it's going out of the bank. And also if you have large facilities to be granted, right? So it's very important that if you are in the treasury, you should be having close relationship with the corporate and the retail guys. And in turn, the retail and the corporate guys should keep the treasury guys posted of any large inflows or outflows, right? A demand and supply of funds. Then you should know in advance, wherever possible, when the bank's biggest credit or deposit customers plan to, right? You have to have close relationship with your customers. You should know when they are going to withdraw and when they are going to put deposits. In cooperation with senior managers and directors, you must make sure the bank's priorities and objectives for liquidity management are clear. Liquidity management is given the highest priority. There is no control over sources, but banks can control the users. Because you can't put a gun on a customer's head and ask him to put money in a bank, no. But where you deploy the funds, that you can control. It's within your control, right? A bank's liquidity needs and liquidity decisions must be analyzed on a continuing basis to avoid excess and deficit liquidity positions, right? So they can be damaging if you're on the wrong side. If you're illiquid when the entire market is illiquid, or if interest rates are very high, then you might be at a disadvantage. But if you're liquid when the entire market is liquid and the interest rates are very low, then also you are at a disadvantage. But if you are liquid when the market is illiquid and interest rates are high, then you can call the shots. You're on a better wicket. Also, if you're illiquid when the entire market is liquid and interest rates are low, still you're better off, right? So you have to have awareness of what is going on in markets and when to have build up your liquidity buffers. Any questions up to now? No questions?
No, sir.
Yeah. By the way, Dinesh Pera is not the Dinesh I know, right? Dinesh? You have fallen asleep? Yeah. Well, after lunch, it's anyway tough. So it's very natural to fall asleep. All right, so let's continue. Estimating a bank's liquidity needs. There are three methods: sources and uses of funds, right? Important area once again. The structure of funds approach and the liquidity indicator approach. Each method rests on specific assumptions and yield only an approximation of actual liquidity requirements at a given time. As you can't get your exact liquidity requirement, but you can do an approximation. Okay, so let's go through each area. The sources and uses of funds approach. Banks' liquidity rises. Banks' liquidity rises as deposits increase and loans decrease. It's a positive gap. And the bank's liquidity declines when deposits drop and loans increase, isn't it? When the supply goes up, that means when you get more deposits and you loans get settled, your liquidity increases. Likewise, when the deposits get withdrawn and when loans get drawn down, then your liquidity drops. That's a negative gap. Whenever sources and uses of liquidity do not match, the bank has a liquidity gap. When the sources and uses do not match, there can be a liquidity gap. Steps in this approach: loans and deposits must be forecasted for a given liquidity planning period. Right? You need to forecast the amount of loans and deposits. Maybe you can use your budgets, right? Or you can be discussed at ALCO. The estimated change of the same must be calculated. And you must estimate the bank's net liquid funds, whether you have a surplus, net liquidity position, whether you have a surplus or a deficit. Estimation of loans. Banks use statistical techniques, management judgment, and experience to estimate the amount of loans. Right. So statistical techniques, you can use statistics. Maybe you can do a trend analysis, or you can go by historical records, do a little bit of research to see if there are any loans coming up during a particular period of time. Right. Now, normally, if it's December and all that, perhaps drawdowns are less because people and companies, corporates may wind down for the year, right? So January might be a little more active. Things like that can be analyzed. Management judgment, you can use your experience and judgment. Loans for a period is a function of economic growth, When the economy is growing fast, then there will be more loans being drawn down, GDP growth and business sales, right? Because when businesses are doing well and then when things are moving, there will be more demand for funds. Projected quarterly corporate earnings. A quarterly earnings will give an indication of how the company is projecting itself for the next time period you're considering. So if they have plans of expansion, then the need for liquidity might increase, meaning you might have a lot of demand coming up for loans. The rate of growth in nation's money supply. And when money supply increases, again, interest rates might drop and that might increase consumption. People might start consuming more and more. And when consumption goes up, on one side, consumers or your customers might want more funds to consume. And on the other hand, even corporates might want to build capacity and expand, right? So there'll be demand for loans and even deposits might go out, right? Projected prime loan rate minus commercial paper rate. So the difference between PLR and the commercial borrowing rate. So if the gap widens, then the demand for loans might drop, but if it reduces, the demand for loans might increase. Estimated rate of inflation, right? Inflation can have various impacts on loan demand, right? So if you expect inflation to go up quite steeply, then loan demand will drop. Okay, so it's now the loan disbursements or amount of loans that are to be disbursed is going to be a function of all of these factors, right? You can't look at one factor in as a silo, right? So deposits for a period is a function of projected growth in personal income, estimated increase in retail sales. Okay, so if personal income keeps growing, then the amount of, now if a person's salary is increasing, right, the amount of deposits he makes will also increase. Then estimated increase in retail sales, right? Retail sales, if the increase in retail, there's an increase in retail sales, then perhaps the amount of deposits you maintain will drop because people will demand more funds for their purchases. If money supply goes up, perhaps you might have more deposits coming in. Projected yield on money market deposits. And money market deposits, if interest rates are high, you're offering good rates, attractive rates. If rates are sufficiently high enough, then money will start flowing in. Again, the estimated rate of inflation, right? So inflation has an impact on deposits as well as withdrawals. So sources and users of fund approach. The estimate calculates the estimated liquidity deficit or surplus as the estimated change in deposits minus the estimated change in loans, right? The change in deposits minus the change in loans gives you the estimated liquidity deficit or surplus. Change in deposits minus estimated change in loans. If deposits are increasing and loans are reducing, you might see a positive impact or a surplus, right? A deficit will be if deposits are reducing and loans are increasing. Future deposits and loans can be divided into three components, a trend component, right? So you can look at the trend, what is happening over the last several years. Are deposits going up or going down? Seasonal components, like various seasons like New Year or Christmas, you can see what is the impact. Or a cyclical component, mostly to do with economic cycles. Right, shall we try this example? It says, suppose that the bank estimates its total deposits for the next 6 months to be 112, 132, 121, 147, 151, and 139, while its loans will total an estimated 87, 95, 102, 113, 101, and 124, right, over the next 6 months, respectively, over the same 6 months. All figures are in billions. Under the sources and users of funds approach, when does this bank face liquidity deficits, if any? Okay, so you have to only use this equation, right? Estimated change in deposits minus estimated change in loans. That's what you need to use. Right, so let's give it a try. This is the situation you are faced with. Let's see what the change in deposits will be. From the first month to the second month, deposits have increased from 112 to 132. So that's an inflow or an outflow. Yeah,
Inflow.
inflow. It is 132 minus 112. There's an inflow of 20. And when deposits go from 132 to 121,
Outflow of funds.
outflow of 9, 11, sorry. From 121, if it goes to 147, there is an inflow of 26. 147 to 151, inflow of 4. 151 to 139, there is an outflow of 12. Then on the loan side, change in loans. So when loans go from 87 to 95,
Outflow.
there's an outflow. $95 to $102. Yeah. 95 to
Minus 1.
102 minus 7. 102 to 113 minus 11. 113 to 101 minus plus 12. Because 113 goes to 101 means 12 gets settled. 101 to 124. Surplus or deficit? What do you think? Yeah. We have 20 coming in, 8 going out. Then after the second month, you have 11 going out and 7 going out from loans. That is 18. Fourth month, 26 comes in, 11 goes out. So net is 15. Fifth month, 4 comes in, 12 comes in, net is 16. And sixth month, 12 goes out, 23 also goes out, right? So 35 goes out. The question says, under the sources and uses of funds approach, when does this bank face liquidity deficits? What do you think? When? During which month? Yeah.
Third and
Yes.
sixth.
Third and the sixth month. Okay. Okay. Second one is called the structure of funds approach. Structure of funds. The bank's deposits and other fund sources are divided into categories based on their estimated probability of being withdrawn and therefore lost to the bank, right? So there are three categories. First one is the hot money. That means the funds that are interest sensitive. Deposits and other borrowed funds like central bank borrowings are very interest sensitive, so that management is sure will be withdrawn during the current period. Right? Then you have vulnerable funds, which are deposits of which a substantial portion, around 25 to 30%, will be removed from the bank during the current period. Right? So a certain amount will go out of the bank. But unlike hot money, they are not as sensitive, but they're still quite sensitive. Stable funds is a core sticky deposit base. Even if you want them to go, they won't go. Right? Stable funds are the core deposits and liabilities, funds that management consider unlikely to be removed from the bank. Okay, so liquidity managers must set aside liquid funds according to the desired operational rule for each of the three kinds of funds. So if you expect 95% of hot money to go out, then you have to keep it in a reserve. Right? And this reserve is called the liability liquidity reserve. So this is how you maintain if you expect 95% to go out. The reserve that you need to maintain will be your hot money funds, what you identify as hot money, minus whatever legal reserves you have maintained, 95% of that. Then out of vulnerable funds, if you expect 30% to go out, the vulnerable fund base minus reserves into the 30%. And you expect 15% of stable funds to go out, stable fund base minus reserves into 15%. Right? That reserve is called a liability liquidity reserve. Banks must have liquid funds to make good loans. Okay, now, if a bank stops lending, that also can be negative for a bank. So they have to make sure that the lending process does not stop. Okay, that's for one thing is the bank has to ensure that business is sustained. They cannot have negative feedback or experience by customers, and also they have to maintain their profitability, right? Customer relationship is important. Hence, management should meet all good loans in order to build a lasting relationship that will generate deposits in future and earn fee income by providing other services. Right? So the total liquidity requirement will be a combination of the liability liquid reserve, which you have to set aside as an outflow of deposits, and the amount of loans that are likely to be granted. Right? Potential loans outstanding minus actual loans outstanding. How much do you expect to be dispersed minus what you have actually dispersed by now? Success depends on managers' judgment, experience, and attitude towards risk. Banks must define the best and worst possible liquidity positions the bank might find itself in and assign probability to as many of these situations as possible. Right, so let's try this example. So you need to calculate the total liquidity requirement, right, and your liability liquidity reserve would be money is 2,500. You need to keep 95% reserves, right? Which means you expect 95% to go out. But you have already kept a 3% reserve. So net amount of that needs to be added. Then vulnerable funds, 30% reserve. You have kept the 3% buffer. 15% of stable funds. That would be your liability liquidity reserve. That means you expect this amount of liabilities to go out during the next period, right? Then potential loans outstanding. ABC Bank's loans total 135,000, but recently have been as high as 140,000 with a trend growth rate of about 10% a year. So potentially it can be 140,000. You can go up to 140,000 and then 10% on top, right? So it's 140,000. Percent on top is 154,000. Actual loans 135,000. So your total liquidity requirement would be liability liquid reserve is this one as potential loans minus actual loans. That would be your total liquidity requirement. Okay, guys, any questions? Yeah. Questions, so let's move on. Let's try this example. ABC Bank estimates the following: hot money 19,000, and you expect 80% to go out. Vulnerable fund 54,000, 25% might go out. Stable funds 112,000, 5% might go out. The bank keeps 3% as legal reserves. Loans totaled 117,000 but have been as high as 132,000 with a growth rate of about 8%. You asked to calculate total liquidity requirement, right? So it's identical. Liability liquidity reserve, hot money 19,000, 80% reserve. Vulnerable funds 54,000, 25% reserve. Stable funds 112,000, 5% reserve. Potential loans 117,000 but has been as high as 132,000 with a growth rate of about 8%. Loans 117,000. Your total liquidity requirement is right. So any questions? No questions? Okay, so the liability liquidity reserve is just what we just calculated. Right. So this area is on focusing on that. So you can use probabilities to calculate it. The worst possible liquidity position, right? Worst possible liquidity position is when most of your deposits go out and the loans or the advances gets drawn down, and that is when you lose the maximum amount of deposits. So deposit growth falls below management expectations. Loan demand increases above management expectations. Your deposit growth is very low. Loan growth is very high. Right? Faces the maximum pressure on available liquid funds. The bank faces sizable liquidity deficits. Right? When that happens, when your deposits go out and loans get drawn down, you will have a maximum pressure on deposit, on the liquidity. So you need to have good plans to raise liquid funds. Then the best possible liquidity position is where the treasurers are most comfortable, is when your loan growth is more than what you expect and the demand for loans is less than expected. Right? But it might not be the ideal thing for the bank's bottom line. Deposit growth increases above management expectations and loan demand falls below management expectations. You face the minimum pressure on available liquid funds, and the bank faces sizable liquidity surpluses. You have liquidity surpluses. You need to develop plans to invest the excess funds. Right, so let's try this example. You have been given the possible outcomes. The best possible is for you to have deposits of 170,000 and loans of 110,000, right? So deposits have increased more than what you expect. Loans are not as much as you expect, but the probability is 15%, right? Then the most likely outcome is for you to have average deposits of 150,000 and loans of 140,000, right? And the worst possible is for the deposit growth to be less than expected and loans to be higher than expected, right? So that's the worst possible liquidity position. Now, your ideal position should be somewhere in between these. The most likely outcome lies between these two extremes. Many banks calculate expected liquidity requirements as the probability into the estimated liquidity surplus or deficit, right? Now, for example, if we do the working for what we just discussed, There's a 15% chance that you will have loans of 170,000 minus, sorry, deposits of 170,000 minus loans of 110,000. Is the best possible outcome. And the most likely outcome. The 60% chance of 150,000 minus 140,000. Worst possible outcome. Is this. You have the best possible, most likely, and the worst possible outcomes. Any questions up to now? Then we have the liquidity indicator approach, estimating liquidity requirement based on experience and industry averages. Right. So this is, it's like you go by past records, and you might have historical records of how things have gone. Then there might be research work being done, and things like that is being used for the liquidity indicator approach. Then you can have multiple indicators, like the cash position. You don't have to remember any of these, which is the ratio of cash and deposits due from deposit institutions divided by total assets. Right, so higher the cash position, higher the liquidity. The liquid securities, government securities divided by total assets. So obviously higher the ratio, higher the liquidity. Central bank position. Central bank funds sold minus central bank funds purchased divided by total assets. Higher the ratio, higher the liquidity. Then you can have capacity ratio, which is net loan and leases divided by total assets. Higher the ratio, lower the liquidity, right? Because if you have granted more loans and all that, your liquidity will be low. Pledged securities ratio is the pledged securities divided by total security holdings. Higher the ratio, lower the equity, because it means you have pledged more securities for your borrowings. Hot money ratio, money market assets divided by money market liabilities. Higher the ratio, higher the liquidity. The core deposits are core deposits, which are deposits less than 100,000 divided by total deposits. It varies with banks. Higher the ratio, higher the liquidity. Deposit composition ratio is the demand and time deposits. Sorry, demand deposits divided by time deposits. Higher the ratio, lower the liquidity. Okay. Then central bank's liquidity guidelines. Right, liquidity guidelines of the central bank. Does anyone know what is the liquid asset ratio bank should maintain?
And 20%, right?
Very good, 20%, right? So 20% of all advances should be maintained as, sorry, 20% of all liquid, all liabilities on the rupee side should be maintained in liquid assets. 20% of all liabilities. So all your deposits, if your deposit base is 100, 20% of that should be invested in instruments which are qualified or categorized as liquid assets, right? The Monetary Board has determined by virtue of the provisions of sections 21, subsection 1, that every licensed commercial bank shall, with effect 1st April 89, maintain liquid assets of an amount not less than 20% of it, 20% of its total liabilities, less liabilities to the central bank and to shareholders. Okay, so that is how it is defined. Now, this is the dangerous part, because if you fall short, there will be a penalty. Okay, by virtue of section 21.3, that every licensed commercial bank which fails to maintain liquid assets as required under section 21.1 shall pay to the central bank a penalty of 0.1% per day. Okay, it's 0.1% per day calculated on the amount of deficiency of its required liquid assets. Such penalty shall be paid not later than the last working day of the month succeeding the month in which the deficiency of liquid assets occurred. Okay. So the interesting thing is the penalty is 0.1% per day. So how much is that per annum? 0.1% per day. How much is it per annum?
Is it 36.5%?
Excellent. Yes, you're right. So it is 0.1% per day. Right. Let me share the Excel. 0.1% per day into 365. Okay, so that's a hefty fine, 36.5% a day. 0.1% per day means for every 1,000 rupees you get charged 1 rupee for a day. Huh? Every 1,000 rupees you get charged 1 rupee for a day. And this is how central bank calculates liquid asset ratio. It's the total liquid assets, daily average statutory liquid assets during the month, divided by total liability base, subject to minimum liquid asset requirements. Okay, so it's the total liquid assets divided by the total liability base. And examples or the definition of liquid assets include cash balances with licensed commercial banks, money at call in Sri Lanka, treasury bill bonds, SLDBs, and securities issued or guaranteed by the government. Goods receipts, import bills, export bills, inland bills, cash items in the process of collection, balances with banks abroad, 20% of balances with own FCBU, and 50% of investments in commercial paper and promissory notes. Okay, total liability base subject to minimum liquidity asset requirements. So your total asset base needs to be looked at in calculating the liquid asset ratio. Total assets, total liabilities exclude contingent liabilities as of the beginning of the working day of the previous month, right? Now the only thing is you don't have to memorize this equation. Then signals from a marketplace that the bank is having or exposed to liquidity risk and is facing problems could be that public confidence might drop, right? People might think twice about investing in a bank. Now that comes particularly if the initial experience is bad. And if you go to a branch and the bank does not allow you to withdraw your money, they say they're unable to give you the money today, come back tomorrow or the day after tomorrow, then that might sound some alarm bells. Right? Alarm bells will start ringing. People will lose confidence in the bank. Stock price behaviors. Right? If you observe what is happening to the stock price, it might start coming down, which reflects the confidence that the public has on the share. Then the risk premiums that they're offering on their deposits and interbank borrowings might increase, right? So they might come up with fancy deposit rates. Loss on sale of assets. Okay, because they need liquidity in a hurry, and in their haste, they might be forced to sell some of the assets at much lower prices. Then they might be unable to meet demand for credit, right? If borrowers come to the bank might say that they are unable to lend, which also sends out wrong signals to the market, right? That news also will start spreading, and from the borrowers. Okay, so curtailing business is never good for a bank. Whatever the business that comes to you, you might have to handle carefully. If you are turning it down, you might have to have valid reasons. Otherwise, it can get interpreted wrongly. Then borrowing from central bank, they keep borrowing every day from the central bank, right? Maybe not only SLF, but also using the bank rate. You know what the bank rate is? What is the bank rate? Have you all heard of the bank rate? If you all have seen the central bank monetary policy announcement, they will give SDF, SLF, and also the bank rate, right? So my question is, what do you mean by bank rate?
That's the interest rate charged for when bank borrows from another bank.
And that is the interbank rate. Yeah, you're
Inter-
right. It is the interbank rate, but there is a specific rate called a bank rate, right? Very specially mentioned by the central bank. What does it mean? What do you mean by a bank rate? Any idea? So what is SDF? SDF? SDF means surplus funds can be given to central bank at the SDF rate. Currently, it's 5%. In SLF, if a bank is short, it can pledge its securities, maybe treasury bills or bonds, to central bank and borrow against them. That's called SLF. But if it doesn't have enough government securities to pledge as security, the next option is to use the bank rate, which is 3% above SLF. It's 9%, currently 9%. Okay, so some banks might even go to the bank rate to borrow from central bank. So desperate. Factors in choosing among different sources of reserves, right? You will have to look at various things. Now, these things you don't have to memorize, but you have to be able to give spontaneous answers, like things like cost, terms and condition, what is the tenor, what is the purpose, uh, the reliability of the source, KYC, right? Then how easy is it to access, the transaction cost, whether they are in terms and conditions, immediacy of the need, duration of the bank's needs, bank's access to the market for liquid assets, the relative cost and risk in sources, interest rate outlook and shape of the yield curve, outlook for monetary policy and government borrowings, hedging capability, regulations, right? Things like that will have to be looked at. So with that, we come to the conclusion. Do you all have any questions? Yeah, any questions? So if you have no further questions, we can wind up, right? And I would advise all of you to use the next couple of weeks or the next 1 month wisely. When is your exam? Exam dates have been announced?
2nd of January.
2nd of January, my goodness. So you have a long study leave, no? Isn't it? 1.5 months to go. more than that also. So in 1.5 months, you might forget everything. If that is the case, it will be a disaster. Just make sure you don't forget anything. Stay in touch with all the questions and the papers and all that. You need to practice. So until you all come for the revision class, what you need to do is just go through the notes. Right? You have ample time to study. Go through the notes, try some past paper questions, and if you have any doubts, bring them to the revision classes that we can discuss. We can put it to the wider audience, have a discussion, right? Because it's very likely that the questions you have, the others also might have. Okay. So use the time wisely. Don't take it easy. Don't be complacent. Don't think that you have a lot of time in hand. Right? Use the time intelligently, and just make sure you are ready for the exam. Since you have time, you can practice exam questions, and maybe you can even time yourself. Right? The first couple of papers, you don't have to time yourself. Take your own time, maybe even a couple of days, and do it. Right? So by I think IBSL has questions with answers. So buy those booklets and go through. If you don't know the answer to a question, just go through the answer also, so that you will learn while you practice your papers. Right? So that's the best way of doing it. That will enhance your knowledge further. So that's how you should do it until you get to the revision classes. Right? So during the revision classes, we will do further revisions. And I will revise everything that we have done, right? So that the memory is fresh in your mind, and you will also learn exam techniques, right? Okay, so that is about it from me. And now that the syllabus is covered, this is where my liability ends and your responsibility begins. Okay, so it's over to you now. Thank you very much. I hope I was able to impart some knowledge on you. And the most important thing is that I do not want to see you guys in this class again, right? So all the best with your studies. Thank you so much. Stay safe. Just make sure you pass your exams and don't delay any further. If you can, take all the subjects and finish it off. Don't become a fixed asset to the institute. Okay, so that's about it. Thank you so much.
Thank you, sir.
Thank you, sir.
Thank you, sir. We'll see you at the revision class.
Yeah, thank you.
Thank you, sir.